Howdy, Jacob here. Today we're looking at National Steel Company 122 in our dividend yield screener, ticker symbol SID. They're in the metals and mining industry with a $4.85 billion market cap and a $9.1 billion enterprise value. Looks like they operate out of Brazil and Latin America. And so the business itself, 2013, $7.37 billion revenue to 8.5 billion in 2022, but it's very swing-like. So 2015 was cut almost in half from 2013, and then that over doubled to 2022. So very volatile business, it looks like, and you can also see it from their earnings per share and their return on invested capital, where it's as high as 22%, and then sometimes negative due to not producing positive earnings. Margins, however, again, I mean, it's cyclical, but 10 years ago, their operating margin was 16%. This past year was 20%, and then gross margin was 28% 10 years ago, and the most recent year was 30%. So it looks like the margins are actually improving, which is great. Let's look at that balance sheet. So 6.8 billion in long-term debt, which is quite a bit less than what was in long-term debt for the business 10 years ago. And then short-term debt is a little less than a billion, so roughly the same. Cash and cash equivalents plus short-term investments, we're looking at maybe 2.5 billion combined, which still leaves quite a bit of net debt here. But if we look at their 5-year average, you see negative in 2022, rolling 12, almost 400 million. But 2019 and 2021, humongous free cash flow years. And it's weird that they actually went into debt this year where they made $1.5 billion in free cash flow. That's a bit odd to see. But this 2022 makes sense. 1.7 billion in debt due to them making an acquisition and having a negative free cash flow year. But if we take a 5-year average, maybe we're looking at an $800 million free cash flow, 5-year average. And again, that includes a very low 200 million, a negative, but then 3 very solid years of free cash flow. And so due to it being a cyclical business, you're definitely going to want to take numbers on it as they are on averages. And this company has enough debt to where this dividend payout immediately I'm going to want to cut in half. Let's say 500 million is still going to be let's take 66% off. So this would have about a $340 million aggregate payout, and then the rest, obviously they might do a little bit of share buybacks, a little bit on the acquisition side, but I want them to start paying down this debt. And so when you want something to pay down debt, you're going to need excess of your free cash flow to do that. And so I think I'm just going to be cutting down this dividend. So they can use that excess free cash flow that's not going towards dividend, not going towards acquisition or share buybacks, to go towards paying down this debt. And it's not excruciating. I mean, we're looking at maybe an $8 to $900 million 5-year average, and it's 6.8 billion. So that's maybe 8 times 5-year average free cash flow. It's still way more than I want. 5, less than 5 would be preferred. I mean, less than 5 is like, I guess, but like 2 to 3 is definitely 2 to 3 years to pay it out, and the 5-year average is definitely more so what I'm looking at. So to me, I want them to really start focusing on paying down that debt. As for growth of the business, I think it's very cyclical. So maybe we'll see 1%, maybe it'll drop down, then come back up, go a little bit higher, but pretty much no growth. So I'm having, after 7 years, maybe there isn't any margins. I'm going to take an average because, again, it's a very volatile business. So let's do 12, 10, just to get a range of margins here, and then no share changes. And we surprisingly, interestingly enough, get to a price that's pretty close. We're saying that company stock price needs to fall 8% before we get a 15% return given these assumptions. I think I'm going to do further. Oh, well, okay. Well, before I say that again, let's do margins again. So 6.8 billion, let's say 7 billion, 2% of that. If interest rates increase 2% on their uh, debt, then we're seeing about 140 million. 140 million in relation to 8,900 is going to be roughly 20%. So let me shave this off to 10 and 8. If you didn't see what I did there, so initially I did just what the average was the last 5 years, but of the last 5 years, interest was relatively flat on debt. And so since interest rates are going up, I took I said what would be a 2% increase in their interest rates? How would that affect their debt? And so it affected them roughly 20%. And so I shaved off 2% from their net income and free cash flow margin to say that their interest expense is going to go up because the company has a good amount of debt on hand. And so this gets us to a final price that needs to fall 23% before we get a 15% return, given these assumptions. I think that's fair for now, and until it gets a little bit closer, I'll do further research, or I'll do further research once it gets a little closer. But for now, I'm just going to be expanding my the companies on my dividend yield screener to see if anything else is a better deal right now. Thank you, and have a good rest of your day.